Yeah, good evening and very warm welcome to all of you on behalf of Resurgent India Limited. In the series of webinars, the knowledge series of webinar since last 1.5 years, I think this is something around 88th webinar of Resurgent India, which we are organizing on the very important topic today, this international trade finance opportunities for MSMEs. So I think this is a very, very important topic which we need to discuss, and we have a very good panel today. We have bankers, we have senior bankers with us, we have the company which is for factoring uh, agency, and we have the fintech partners also. So this is a very good platform where we can discuss about the various topics of the global trade finance from the MSME point of view. So friends, first of all, I would like to thank you to all the panelists for joining with us in this today's webinar, and their confirmation also at this very short notice. So we have Tabrez sir, Tabrez ji, the DGM of State Bank of India. He looks after MSME department. He's the right person to speak on that. Actually, he looks after product and policy. Then we have Sankara Narayanan sir. He is the GM UCO Bank of International Division. So he has very good experience of the international financing. Then we have Ramesh sir, Shriram sir, who is the former ED of ED-Dena Bank and the GM of Central Bank of India. Then we have Ravinder sir, who is the Vice President of SBI Global Factor. And we have Randeep sir, who is the regional head of Structured Trade Finance of ICICI Bank. Then we have Mr. Dhruv Bajaj, who is the director of Enkash, the Fintech company. So we have a good panel. So first of all, thank you very much to all of you. Friends, if you see this MSME global trade financing, so as of today, if we see the overall trade finance is something around 80 to 90% world trade today relies on the trade finance actually. And one of the most reliable form actually, the global trade finance is one of the most reliable form where the rejects or the defaults are less than 1% actually. We see the NPAs are hovering in the 2-digit, but in this I think global trade finance it is very, very minimal actually. And as per the Asian developing economies, there is a big gap actually. I was reading some report of Asian Development Bank. It has shown that there is a gap of something around $692 billion in the trade finance, so which is a big opportunity for the banks and the factoring agencies to fill this gap. And the MSMEs are actually restricted to get the funding in the global trade finance because of various regions, which we will discuss in today's webinar. And according to the ADB survey, if you see this MSME applications, so they have given them the number that almost 56% applications are got rejected of MSMEs in the global trade finance when they are applying for the global trade finance. So this is a big number actually. The overall thought or overall idea is to basically how this gap can be less actually, or that this can be narrowed down. That is important, I think, which we need to discuss. So there is a major need of the reform in the global trade finance, mainly from the MSME point of view across the world. And because MSME, you know that India is having more than 6 crore MSMEs, and they are contributing to the 30% of the GDP. They are basically contributing 45% of the overall manufacturing and 40% of India's export actually. So this is a big number actually. We see their contribution, the overall economy and the GDP. So we need to, I think, definitely see it from a positive point of view. And you see, for MSME, 75% funding is coming through the informal sources because of the financial literacy or maybe the other factors, the knowledge, awareness. Awareness is one of the factor actually, which is very, very important to see that how they are aware about the different policies, different incentives, different schemes of the bank. That is important. And now the time is running out for Libor also. This there is a transition in the Libor. So I think this immediate action is necessary from the Libor point of view, where I think before 31st December, we need to have the complete ecosystem in place so that the existing trade or existing financing, which is something around $400 billion across the world, should not be affected actually. That need to be discussed, which is very, very important. And if you see, we have to see that how this our MSMEs can be globally competitive. That is possible when they are having the best solution of the financing that will help them to get the funding at the lower cost. They can get the funding at the right time and the right quantity or right amount also. So technology is also playing a big role. The fintech companies are basically changing the entire dynamics, which is also important to discuss here. The blockchain and the various banks are discussing about the blockchain technology, which is also helping. And there are many forms of export financing or maybe international trade finance, so pre-cement funding, post-cement funding, and there are live or hedging discussions are there, credit insurance there, government schemes, government initiatives are there, technology, factoring, and the risk involved. So these are the areas, 7, 8 areas are there which need to give the attention, which we will discuss in today's webinar. And hopefully, I hope that the participants who have joined us from different part of the country, or even from the international also, they will get benefited. The kind of discussion which we'll have, our speakers will contribute a lot. They are the veteran of the industry. So I hope that this today's discussion will definitely be helpful to everybody, and we will be more knowledgeable about the international trade finance. So friends, now I would like to invite Shri Sankara Narayanan ji. Sankara Narayanan ji, the GM International Division UCO Bank, and he is the person who has seen the international trade in the domestic market also and the international market. He was the helm of affair, the chief executive of Hong Kong operations of the bank, and he was in, I think, Singapore also. So he has seen while sitting outside India and while sitting in India, both the sides. So he'll be a better person to give us the complete outlook about the whatever the initiatives of the UCO Bank and what are the different schemes of the UCO Bank on the export or global trade finance. And sir is having the this certified associate of the Indian Institute of Bankers, and he is alumni of IIM Bangalore also. So first of all, Narayan sir, thank you very much for joining with us, and we would like to welcome you. And thank you very much. And I would like to invite you for your deliberation. Over to you, sir. Thank you.
Good evening, Ashish, Agarwal ji, all the panelists and all the participants in this forum. So basically, I will be discussing about the emerging themes in Indian exports. As I see it, there are a lot of opportunities for Indian exporters. Now, before going into the themes, let me speak about one country. This country in 1950, it was having the income of this country was same as that of India's. Currently, that is in 2021, this country's income is 5 times India's income. Now let us understand how this country has prospered. Next slide. Just a small YouTube 2 minutes video. Just you play the video. This is in 1978. Just see how China is coming up. USA was the topmost trading. What happened? USA was the topmost trading nation. See how China is coming up. Today, China is reckoned as the factory of the world, having a large manufacturing sector with huge scale. I had opportunities to visit China, and being in Hong Kong, China was just across the border. Shenzhen was very nearby. I had seen it with close proximity. See how the position has changed. It has become the number 1. And it has really contributed ultimately to the development of China. Next slide. Next slide. Next one. Now, quickly, let us understand the global ecosystem. The global trade merchandise is around 17.5 trillion US dollars. And in trade in services around 4.9 trillion or 5 trillion US dollars. Global GDP is 75 trillion. And what is India's position? India is having a GDP of $2.6 trillion. And our share of manufacturing is 14% and services is 50%. Next. Now in global merchandise trade, how do we rank? We rank 20th position with a share of 1.6%. And China ranks first with a share of 14.7% of the global merchandise trade. Next. On the services, we are 8th, China is 4th. Next. I am rushing through because we have, so this is a comparison between India and China, how China became a high income country. Now let us come to the emerging theme. How the emerging theme is very positive for exports. See, currently, the most important global agenda is China +1. Because as you know, post-pandemic, China is at a little disadvantage because the global supply chain are looking for an alternative. Now, whether, because China and India both are populous countries, both are having a young population. Now, whether we could capture this, we could become an alternative to China, then definitely there's a big opportunity for us. As I told you, how China has become one of the prosperous countries because of manufacturing. So we can also emulate China once we capture this space. Now, what are the things that works in our favor? Currently, you have a supportive monetary and fiscal policy. Then government is driving the ease of doing business. In fact, every public sector bank and has to be bound by this ease of doing business, and government is closely monitoring it. As far as that, as far as digitalization, everything is very closely monitored by the government. And without digitalization, public sector bank also realize that they cannot survive. Okay, private sector bank is much ahead in this forum, and public sector bank is no way behind. Then there is a disintermediation. You can see that the money market is well developed. Debt markets are well developed. Capital markets, huge amount of capitals is flowing into the country. You can see how unicorns are actually reaping the, the advantage of global liquidity. And again, there are also private equity players. You have global access. So all these are actually supportive of even your investment requirements. And for your working capital requirements, we have the banks, the NBFCs, the Fintech, all the combo work together, provide a supporting framework for the financing your working capital requirements. Now, what are the favorable aspects for India? It is having a favorable demography, very young population. Our population, average population is around 25 to 30, 70% of the population is young. Then digital adoption, highly digitally adoptive, internet friendly population. Cleaner banks are provided for the NPAs, and their capital positions are much better. They are in a position to lend. And again, there is an active NBFC sector also, private bank also are also there. So Fintech has also joined the fray. So penetration of financial services is very good. India is a net exporter of many commodities, steel, in electronics, in pharma. Further, India is mineral rich, bauxite, or you name renewable energy sources, sun energy, everything. India is that way actually, poised for what you call, in an advantageous position. Then we have competitive advantage in cotton, leather, gem and jewelry, food processing, auto, pharma, medical equipments. Then there is a huge focus on exports. We really are, from the current total exports, including service, around $500 billion or lesser than that. We are trying to actually move towards a 1 trillion towards exports in a few years. Then there's a huge consumption story. There's a large population, and now the focus is that actually we should manufacture for India as well as globally, because India is, as it is, labor is very cheap. And again, we are opening up to the external sector also. So there are a lot of interest for companies to set up shops here or have joint ventures here and then produce for the rest of the world. Our technology is very good and labor is cheaper. Now, what are the concerns, or what is the work that is remaining to do? Logistic cost is on the high side. Actually, if you compare comparable trading partners, our logistic cost is indeed many times, those of many other export-oriented countries. Then lead time, there are congestion in the port. As you know, currently actually the export sector is facing issues like, freight is very much on the high side. It has gone several times, and container is another issue. exporters are not getting containers. So there is a lot of lead time and cost overruns. Even for setting up a factory in India, it takes a lot of time compared to many other countries. Scale and productivity, we have to have large investments, then only we can produce scale. Unless we have scale, we will not be able to capture the export market. Further, scale will reduce the unit cost. And another important thing is productivity. We have to create skill sets. Even labor market reforms have to happen such that actually productivity and efficiency should be paramount. There are also competitors. It is not that actually India is the only alternative. There are countries, many countries like Taiwan, Bangladesh, so many other East Asian countries who are competing with India for this position as alternative to China. Supportive monetary measures. You know that current liquidity available in the banking in the system is around 11 trillion. Today's liquidity. Today, I'm giving you the today's figure actually. Today, in the system liquidity, durable liquidity, is around 11 trillion rupees. Banks actually are lending this back to the Reserve Bank of India through reverse repo at very cheap rates. So banks are actually looking at opportunities for lending to corporates and lending at a little bit higher interest rates than what is currently they're getting only 3.35% over, sometimes lower than that. So actually the interest rates are coming down, or the interest rates, there is actually a transmission of interest rates. Whatever RBI wants, that is currently happening. Because of, and RBI is keeping this liquidity predominantly. One of the reasons is that actually that for the transmission to happen also. So low interest rates is a very supportive scenario for credit. The cost of credit will come down. Then exchange rate also, there is a lot of stability, despite the fact that huge amount of cash capital flows are coming to the country. RBI is trying to ease away the volatility in the system by its strategies. So we are having a stable exchange rate regime in India currently. Fiscal measures are also very supportive. You know that the government is now very much focused on the exports. Atmanirbhar Bharat, we have to produce for the rest of the world. A lot of good schemes have been there. There is a decentralization to promote export. All of you are aware, every district in India can be an industrial center. That is what the government is focusing. Even DGFT and even the export associations are all complements to this and working towards that. And PLI has been introduced as an incentive for export. Then you know that there has been a reduction in corporate tax. Again, digital India, internet penetration is very high. And again,
your voice is not coming, sir.
Voice is not coming?
Now it is okay, sir.
Yeah. Then e-commerce, all those kind of advantages are there. Country working towards FTA, because actually, because WTO is there. WTO, see, there are several disadvantages. Actually, some countries are having priority. So unless we are having foreign trade agreements, our export will be at a disadvantage due to tariffs. So India is working towards FTA with UK, USA, Canada, Australia, many other countries. So this is a drive actually to promote exports. And as you might be aware that actually the road scheme is to replace MEIS. So that means the whatever subsidies or whatever kind of support services from the government export sector is receiving currently by way of subvention, that will continue through road. Next slide. Supportive framework, banks. Next one. Now, what banks are offering? Actually, basically, working capital finance is a domain where banks are very active. So, what is working capital finance? First of all, pre-exports, bank need to provide finance for procurement, if it's the manufacturing, purchase of raw materials, processing, and all that. So, basically, banks provide pre-shipment finance. Basically, it is financing current assets. You can bank can give packing credit in rupees and packing credit in foreign currency. It is very important, you know, for the exporter to realize when they should take rupee finance and when they should take foreign currency finance. And what is how you will get that? When you should take rupee, when you should take foreign. You should be dynamic enough to shift your requirement either towards foreign currency or rupee. Currently, actually, rupee credit is much favorable. We'll say why rupee credit is much favorable. I will just explain to you. Then we have the post-shipment. Next. Then we have the post-shipment finance. Post-shipment finance is after the export. After the export, what will happen? You will have receivables. Now, how this receivable can be financed? It can be financed if there is no LC. It can be financed by way of a line with the bank called export bill discounting. If you are having an LC, letter of credit, then bank can do negotiation against the export bill. Then another activity is factoring, where actually the receivables factoring can be done without recourse and with recourse. Essentially, factoring means whatever receivable is there you are having in your books, you are passing the burden to the bank. It is the bank's duty now to collect the receivables. It can be done with insurance and without insurance. We have SBI factors and other fintech companies also. So they will be explaining in much more detail. But factoring is very active. Since I have worked overseas, I have seen, in fact, we have also done, is very active in overseas centers because open trade take predominance over letter of credit there. Basically, there are multinational insurance companies and all that. So immediately, this could be financed by any bank with an insurance cover. So that is how this was being done. In India also, it is catching up. On the domestic side, actually factoring has really picked up. On the international side. Yes, our people, our SBA factors and representative from SBA factors and fintech companies, they will be explaining possibly how on the international side factoring can be made to best use. Even banks are actually now actively looking at factoring in India. So reverse factoring is again supply chain finance, where actually in this case, your buyer will be initiating. It's only factoring only. The buyer will be initiating that kind of trade. Here, in the case of factoring, the exporter will be initiating the trade. That is only basically the only difference. The advantage in factoring is that actually you need not have to worry about the receivable. The worry will be towards the financier, who will collect the receivables from the buyer. In case the buyer default, then there will be an insurance company at the overseas center, or the buyer's country, who will be in a position to actually reimburse towards the receivable. Next slide. Now, financing costs. Financing costs, as far as export is concerned, if you analyze it, is not very high. What matters is logistic cost. Now, why financing cost is not very high? See, currently, actually, exporters are able to, because of course, export credit, in the export credit, basically, for that matter, any credit, actually, interest rate is decided by the risk perception on the board. Any exporter currently should be in a position to get, normal exporter MSME should be able to get credit 7 to 8% is the rate of interest. Assume that 8% is the interest rate cost. The current forward, see, whenever actually, you are receiving an order, there is an exchange risk. Because if the goods are invoiced in US dollar, you are going to receive US dollar. You are having a risk rewards. If US dollar depreciates or the rupee appreciates, then you will get lesser rupees against the dollar. So normally you will hedge. So the moment the contract is signed, immediately you will go for an export cover by booking a forward contract. You will sell US dollars in the forward. US dollar is in a premium vis-a-vis rupee. The current forward premium is around 4.5%. It ranges from 4.3 to 4.5%. So if you are receiving 4.5%, and as you know that for MSME, there's a 5% interest rate subvention. So total what you are receiving is 4.5% plus 5%, that is 9.5%, against which what you are paying is 8%. Your post-shipment part of ECGC premium is also being borne by the bank. Now, you have an advantage that since ECGC whole turnover cover is also there, banks are also, that way at a comfort, because, large part of bank can actually, reduce the collateral also because of ECGC comfort. And there is another scheme the government is right now promoting, and ECGC is actually envisaging this scheme, Nirvik scheme. Once it comes, currently it is 66 and 2/3% cover. The cover will get increased to 90%. That means bankers will have an advantage in the sense that when they are financing exporters, they are getting an assurance of a 90% cover from the ECGC. And for the exporters, because of the incentives and the opportunity to receive forward premium, their interest cost is almost covered. So financing or getting what you call credit, considering that actually government is now very keen to promote exports, may not be an issue going forward, is what I believe. And we as a bank can assure you, we are also pro exports, and really actually we are looking at actually increasing our export credit portfolio also. We will be very happy actually to provide services to you. Main issue is a cost towards logistics, and we have to see how this has to be brought down. So once this is brought down, actually, and further through scale, you can reduce unit cost, and way of efficient production. Actually, you can add value to the customers, and that will be win-win for you as far as export is concerned. Now, what are the evolving themes? Financing open trade through factoring and emerging theme. Why? Because actually, till now, actually, banks were having some say in the what we call factoring business, but now that is going to get open for NBFC. And as you know, NBFCs are at the edge of innovation, and there are fintech players also. So factoring is going to catch steam, and once factoring comes, there will be huge competition, and competition will further lower the prices for the exporters. So there is a big opportunity for the trade going forward. Blockchain. Now, what is blockchain? There are experts and they will cover it. Actually, it will take a longer time to cover that. But what is going to happen because of blockchain is, what is blockchain? Let me tell. Actually, it is actually a physical, financial, and messaging layer, integration of the physical, financial, and messaging layer towards a frictionless, trust-based ecosystem. What does it mean? Today, how does export work? You have to actually send the exports through ship. So there's a transportation layer. Then you have to courier the document. Again, there's a physical layer involved there. Then financial layer, you will get the payment through the financial system by way of Swift messages. So again, there's a messaging layer, there's a payment layer. So physical layer, payment layer, messaging layer. There are three distinct layers currently as far as international trade is concerned. Blockchain is a way of integrating all the three layers into a single layer. And there are various efficient ways of actually automatically triggering the payment through smart contracts, etc., etc., etc. And it's a trust-based ecosystem where actually, the entire chain and audit trail of the transactions will be available. So that is again going to be a big hallmark. And in fact, in Singapore already, the MAS has introduced blockchain for trade. Actually, the bill of lading now, as far as Singapore is concerned, it is on blockchain. Actually, banks can verify even the bill of lading through blockchain. So that is an evolving technology. And on the manufacturing sector, next slide. As I know, manufacturing sector, what is the advantage in manufacturing sector? Why it is important? Why China prospered? Every 1 rupee spent on manufacturing has a 5 times effect on the GDP, because your job employment will go up. Again, there will be further procurement of the economy. There is a cascading effect, and the effect will be every rupee spent, and there will be investment. Every rupee spent actually will contribute 5 times to GDP. That is how China has prospered, and that is how India will prosper. Without manufacturing, transfer to higher income is difficult. Now, we will just concentrate on what are the drivers. What are the drivers of international trade? Major drivers of international trade. Invest for scale. This is very important. When I was studying the 10th standard, Maruti came. Before that, actually, I remember only with the very rich had cars. Fiat and Ambassador, every year only 20,000 cars are produced. Maruti came. At the first go, he started producing 2 lakhs cars. And because of scale, the unit cost came down. If they could deliver a car at a very cheap price. Yes, I was telling an example just to remember, Maruti, why scale is important to bring down your unit cost. Similarly, standardization of your product, that is very important. If you want to produce scale and mass, you have to standardize. In fact, when you go to China, the market is flush with goods. Anything, electronics, toys, anything. And they are able to sell you at whatever price you ask. This is the bargain price they will be able to sell. Why it is so? Because their unit cost is lower through scale and standardization. So this is very important if you want to drive the manufacturing exports. Then, if you want to concentrate towards differentiated high price segment, then you have to innovate. There, once you innovate, it is price agnostic, and you can provide to the bespoke need of the world, and you will have sustained competitive advantage also. Next. Quality, of course, it is very important. It is key to enhance customer value and willingness to pay of the customer. Digital, as I told you, it offers large possibilities. E-commerce is it offers immense scope. Currently also it is offering immense scope, as you know, eBay, Amazon, you name it, actually, a lot of possibilities are there. I think FIO also is having, certain site where actually you can offer your products through what you call, they can also facilitate. You can touch base with FIO on this. Then leverage on customer shifts as it is customer, proximity economy. Currently, actually, because of COVID, as you know, our mask is becoming a fashion garment. And again, e-commerce offers tremendous scope. So these are the actually, the new opportunities that have come up. Right the way, as I told you, embrace a global supply chain, which will be a very great benefactor for the India in the manufacturing side. Strategize, build alliances, push for market share, identify new growth engines, diversify your exports. See, 80% of our exports are from 21 chapters of HSCO, out of 99 chapters. So there is a lot of scope for diversification of exports. And for that, we have to invest in R&D. Best wishes. We honor your trust. Thank you. Touch base with us. We are here to promote exports. So are people so are our participants, delegates in the panel. All the best. Thank you.
Thank you, sir. Thank you very much. I think you have set the tone and you have covered very well all the areas of trade finance, and you have guided the MSME players also that how they can grow their business also, what are the opportunities.
One more thing I left, actually, you also told about Libor transition. Actually, let me tell you, Libor transition, currently the challenge is actually Libor was having a term structure. You were able to know, suppose you are discounting an export bill, you will be able to know what is the amount that you will receive, because interest rate, what the next 3 months, next 6 months, what is the interest rate, The problem with alternate reference rate hitherto was that actually alternate reference rate, for instance, SOFR, secured overnight funding rate, it's a rate actually predominantly an overnight rate. So term structure has to evolve. It will take time. But currently, actually, CME has already started, who is actually the benchmark provider, has already started providing term rates in SOFR also. For 1, 3, and 6 months, it is there currently. So other tenor benchmark has to evolve. So actually, many things are emerging. Ultimately, after though the Libor will continue for legacy contracts up to June 2023, but again, for new contracts from 1st of January onwards, it will predominantly on alternate reference rate. For US dollar, it is SOFR, secured overnight funding rate, and for GBP is SONIA. So in each country, there will be a reference rate, but market participants are actually, very much seized with the challenges, and I don't think that there will be any challenge as far as transition is concerned. It will happen smoothly.
Thank you, sir. Thank you very much. So thank you, sir. We have now Tabrez ji. He is the DGM State Bank of India, the MSME department only, and as you know that State Bank of India is the largest bank in the country in terms of the total size of the bank. So Tabrez ji has very good experience of working in different departments, but currently he is into MSME department, where he is looking after the designing of the product policies for MSME and digital lending platform also. So nobody can be better than the Tabrez ji. So Tabrez ji, we'd like to invite you for your deliberation, and we'd like to understand what are the schemes, what are the incentive or the opportunities are there from the SBI side to the MSME exporters or from the international trade finance part. Over to you, sir, and thank you very much.
Thank you very much, Ashish. Thank you to all the delegates, and thank you to all the. I suppose I'm audible now.
You are audible, sir.
Yeah. So regarding MSME, this topic is very challenging also, but very interesting also. I'll just like to say that that SME business person is the one who has either started or inherited his small business. He knows his business brick by brick, loves his business, and holds command at every nook and corner. He only looks after productions, quality control, marketing, logistics, finance, and the various other issues, because he is totally engaged into this. But when it comes to the context of SME unit engaging in exports, the activities and requirements on compliance fold increases many times. I'd like to focus over the compliance angle a little bit. There are enough potentials and opportunities for a MSME businessman. I mean to say MSME entrepreneurs. They need to look forward. They need to look out of the country for the demand of their products. And there are various schemes, finance available by the banks. I'd like to come to that. But before that, SME person need to understand that they have to grow. And if they want to sustain the new economic order, they have to become a good exporter. And lots of facilities government has come up. Banking are coming up. As a banker, we feel the responsibility to fund the exports, because it is not only we are funding the exports. As a banker, we get the opportunity to contribute to the development of our forex reserves, the nation's development. Lots of improvement will come. So now, as a SME businessman, to become an exporter, this is very important, that they should be aware that gone are the days when things used to be very tough in the name of FERA. And now, any once in India, obtaining USD 10,000 for overseas visit used to be a tough task. It was a challenge. And now one can have a prepaid forex card charged online up to $25,000. So that means what I'm saying, that whatever the products the MSMEs are producing, they have to see the potentials available. Lots of potentials in electronics items, in handicrafts items. Most of these things are being produced by the MSMEs, textiles, clothing, footwear, toys. Lots of exports are there. Need to understand that, because the forex reserves we have, we are the fourth largest forex reserve holding country globally. What are the products? I understand the time is not enough, but I just want to share that very important aspects. My PPT available, I suppose.
Yes, it is visible, sir. It is visible.
Visible, no? Okay. So as an MSME, those who are not exporter, they can become exporter, provided the product has got a strength. In India, I tell you, there are lots of products which have got strength. Rather, I can say our SME entrepreneur, if they are not exporting their product, they are depriving the world from their product. Not only this, they are depriving the country from the forex. So both the angles need to be looked. Now there are so number of products. I understand it is not, the time is not there, but I just want to sensitize that you please ask, you please demand. You visit to your bankers and you ask what is EPC, what is export packaging credit. This is very simple. As a banker, when I joined the bank in 2000, my bosses used to say, go and fund the EPC. At that time, it sounds to be very tough thing, but it is nothing. It is simple funding raw materials, which is required to manufacture products to exports. So any exporter or any MSME forward, today you are an MSME entrepreneur, you visit abroad, as I said, at $25,000 you can have, you go for the marketing of your products, you get the orders from outside and come to your bank and just say that this is the order I have received and I need the money. He will instantly give you, I tell you. But some things is that you have to be exempt port. There are some formalities that is again a very single window now in this last so many years. Things have ease of doing business has been come up. So it's not very easy. It's not very tough to get it. It's very easy rather to get exempt code, code and all those formalities to complete to become an exporter. So then there is a pre-shipment credit in foreign currency also, in rupee also. Export bill negotiation discounting, that is a post-shipment, as already it has been discussed. Once you export, you you send the goods outside, a bill is generated, shipping bill is generated, submit it with the bank, they will again discount it and close your pre-shipment. So your cycle, cash flow cycle is linked in such a way that you will not find any problem in funding your exports. Then there are advance against bills sent on collection. Let's suppose you have not taken any pre-shipment. So you have sent the goods on, that is advance against bills you have sent without availing. You will get advance again. Receivable financing, factoring, I think that will be discussed in this. All these products are easily available. The only thing is that you need to be aware, you need to demand it. Then there is a product, foreign currency loans, FCNB demand loan and term loan. That's easy, very competitive rate. the banks are providing it. There are other products, EEFC account. You are an exporter, you can have export earning foreign currency account. Then ECGC cover guarantees you the losses or the lapses, what you call, and the forward contract. Every exporter need to be understand the importance of the hedging and how to hedge my exchange and interest rates. And this product is also, sometimes it is called derivative, but these are simple products, hedging, that is also available with the bank. Then import LC, SBLC, we call it a standby line of credit, trade credit, buyer's credit, supplier's credit. Everything is available, and it is just you have to ask, you need to understand from the bankers, what are the products, how can I get it, benefit from it. Buyer's credit, again, a very cheap rate it is available. Buyer's credit, if you are importing anything. See, for becoming exporter, sometimes we need to import something out, either technology, either raw material. So these are the basic two products. I need to just highlight it that these two products are purchase of raw material, cost incurred towards processing, manufacturing, packing, and meeting other expenses. These are at concessional rate of interest equalization scheme of RBI is also there. I'll also explain now what is the cost. You'll be surprised to know what will be the cost, effective cost. And finance is available up to 90% of the LC or order value, even if not LC order value. And depending on the working capital cycle, as per the FEMA guideline, free shipment can be given up to 270 days. So that's enough time that is provided there. And then there is a order-to-order facility or running account facility. If you're a good exporter, having a good track record with the bank, it's a running account facility. It's like a CC. And self-liquidation in nature, because once you avail this EPC and you prepare the finished goods, you ship that goods, you get the invoice, shipping bills, and all those things, and you get submitted to the bank. That bank will not only discount it, the bank will also arrange collections from the abroad. Then there are in foreign currencies also, Euro, GBP, Japanese yen, 4 or 5 currencies we are issuing it, US dollar. So again, FZN, sometimes it is preferable that as you have to plan, as a businessman, you have to plan which fund will cost less to me. And that again, I say, as a MSME entrepreneur, the MSME entrepreneur need to move out of the factory and learn the financial aspects also. Then how can I can save my financial cost? That is also interest. So there are tools available, like it is hedging, availing the loans in foreign currencies, all these benefits that can be taken into account. Then there is the exporters gold card scheme, and that is introduced in Exit Policy 2003-4. It's a very simple, good track record borrower. It is automatic 10% additional enhancement every year, and the renewal is for 3 years. So account need to be good, yeah. So this again benefit, RBI has said that every exporter need to be given exporters gold card, and under exporter gold card, again greenfield also project can also be considered. So we should take the benefit of all these facilities. And shipment, as I said, that post shipment basically means once the bills has been generated, invoice has been generated, you can avail it. And there the financing is available up to 100% of the invoice value. And the credit interest rate concession rate is available for 180 days. The only things when you are exporting, you have to be very careful about the compliance. Its compliance is not very tough. It's simple. Government want when you are exporting, please make sure that the currency from outside comes to the India, because when the goods have moved equivalent amount or with a profit, the money, the currency should come into India. And that's why there's a shipping bill has to be submitted to the bank to ensure that the evidence is there that yes, goods have been moved out of. And see, this is the matrix that was discussed with the exporters meet also few days back. So what is the cost you are coming? See, all EPC facilities now, we are giving it as a card rate of T-bill linked to PA credit. So generally, when we say there is a subvention of 5%, and for a card rate is 6%, and others it is 6.25%. If it is a better rated AA, then 6%, others 6.25%. So for to MSME, what is the effective rate? You can see that 1.25, and that can go again lower if you hedge it. there is earning from the hedging also. So why not I should export at 1.25%? That's the best thing that is there. Only I think the MSME need to understand the potentials, need to utilize this, need to exploit these avenues. And what are the SBI initiatives for trade finance customers? Last year, with the introduction of NCGTC, that is emergency credit line guarantee, all of them have been provided this 20% facility additional fund. Then extension of trade credit period also took place in RBI guidelines from 12 to 15 months. And we are working with IBI to devise alternate and safe mechanism when document movement was hindered during, that is, bill is introduced. And the other rationalization of exports related service charges, other forex charges. We are working also with ECGC for improved coverage and claim processing. We are definitely organizing. You can see this is again a very important event that Resurgent India has come up with. Exporters meet, webinars, knowledge sharing workshops are also conducted with ICICI, and working with Bangladesh, Russia, and other banking bodies for resolving trade-related issues. So these are the things. My number is there, my mail ID is there. I'll be happy to provide any sort of clarification, support. I understand time is constant. So I've just given a snapshot of the product. Want any detailed product, you can approach your bank or even to me. You can mail me, I can provide you in details. My only request that realize your potential, go abroad and see the world and let the world see your products. That's it.
Great, sir. Tabrez, sir, I think you have given a very good, comparison of the different schemes, government schemes and the SBI scheme in a very transparent manner. And I was surprised to see that whenever the exporter is doing exporter, they are getting plus 3% kind of advantage rather than paying any interest to the bank. Actually, this after hedging, taking the advantage of hedging and the subvention and all. So plus 3% actually. So practically this is a positive factor for them. So I think a lot of people who are joined this webinar, they will be benefited out of it. Thank you very much. Now, sir, we have Ramesh Shriram, sir. Ramesh, sir, is the veteran of the banking industry. He was ED of Dena Bank, then GM of Central Bank, and he has very rich experience of the export-import finance and this meeting out the bank requirement for foreign currency export finance also. So, sir, first of all, thank you very much for joining with us. We have a lot of questions actually from the audience also. So, sir, we would like to understand from your experience in the past and how do you see that the current ecosystem which is there for export financing? Is it sufficient or do you have any suggestions on that? Over to you, sir. Ramesh, sir. Sir, your mic is mute, sir. Sir, still it is on mute, sir. Now it is.
Is it okay?
Yeah.
I first of all, good evening to all my respected people over there, especially the exporters community who are joining across the country and have been doing excellent job for the country for all these years. It is for them that today's exchange reserve for the country is $600 billion plus. They have been playing extremely very, very vital role for the country despite all odds they may face, particularly since I already left the bank. Is not that I'm criticizing the banking community. I do know the hardships being faced by the exporters, even for getting the financing from the banks. Also, once they get the financing from the banks, there are lots of hardships they face, right from the customs clearance till shipment of the goods, and then getting relation from the country which is not in their control. I really appreciate the courage, the entrepreneurship, and their intelligence to ship the goods and then get the relation from the country from the people who are beyond the reach of Indian territory. So they really play a very, very vital role in the economy of the country, especially when 30% of the GDP comes from the export from this SME sector. And really, hats off to all them. As far as my experience concerned and the challenges which I feel, the things which are required to be done is definitely the banker community have been doing excellent job for all these years. And even today, with digital economy or e-platform, they are reaching out to the exporters. Let the exporters should also understand their own problem. One, if they are to go for any export financing, export, say, a working capital lead from the banking community, they first of all, they need to have the import-export code registration done. Then they should also have the export order on with them. They should have done thorough checking on the overseas buyer, because I know in my tenure how difficult it was to, and even today, to get the export realization through the Bangladesh. Even against the letter of credit issued by them, the money coming is very, very difficult for, even today it is so. That's why it is said that the exporter should ensure that the overseas buyer to whom they are going to start the, say, selling the product, they also have done the proper due diligence. Though banks take the credit report, other reports from the overseas buyer, from the various credit agencies available with them, still the exporter community should see to it when they go for all these things, they do proper test checking with the, because I have seen where they are lured by the huge export order, a small advance payment is made, and then we ship the goods and then become almost dead, because once they get the money is not coming at all. So really, it is indeed a matter for exporter to see to it they have the all the record, export order on hand, import export code they already done with. They have also done from their own side the credit, credit report obtained on the overseas buyer, and the arrangement how the money is going to come, because there are various countries where the explanation, because of various problems, the money cannot come through. There may be embargo from the US or a European country where the dollars or euros cannot be transferred to. So all these things are there. Then they should see to it like in India, when they do so many domestic kind of credit funding from the banks, the bank takes all the precautions, whether the my customer is trustworthy, whether bills which they draw, they will be paid, on which bank they are being drawn. So also here, the exporter will have to see to it they are taking every precaution to when they enter into the export contract, because once the ship is loaded and left, he is at the mercy of the overseas buyer. I've seen when the dollar, say, one contract they were done for one piece export for $10, and dollar rupee was at 73. He's very happy. Yeah, I'm going to get 73 rupees per $1, and my product is 10. The moment there is some problem with the country and worldwide, the overseas buyer will start arm twisting to you. He will say, okay, this product I will buy only for $6 if the exchange rate is against him, and so many problems will be created. So when the exporter community are facing all these problems, they are supposed to be extra precautious while dealing with the export orders. And since though we say that letter of credit is the safest mode for getting the export finance, they are very minimal. Only the top credit people, they can get the LC open in their favor and get the goods, the export financing easily from the banks. So they need to ensure that when they are into the market, they are facing the problem, not only domestically, because there are various MSMEs who will be there, but at the same time, they should see to it that when internationally they are going into this business, they see to it their competitive countries are really not, say, outlining them. They should not be in such a way. I'm selling product for $10. He goes there, Chinese people who said maybe Bangladeshi, and offers it for $9. We will be out. So we have to be cost competitive for all these things. I really appreciate the Reserve Bank of India's initiative taken, Government of India's action taken on various policies they have introduced. Atmanirbhar Bharat, Reserve Bank of India keeping the stable exchange rates, Reserve Bank of India also directing the banks. And even only last week when the FM was in Mumbai, she had already directed all the banks to extend full support for lending to the exporter, because we have to be a $5 trillion export community very soon, and then $1 trillion community very soon. So with these things, I feel my expert communities will also boost up their efforts to see to it they approach the bank, get the funds, and also play whatever role they will be playing 30% GDP, they should be increasing it more and more. Thank you so much.
Thank you, sir. Thank you very much. Crisp and short, but you have given a very good message to all the MSME players that how they can basically manage or how they can see the things from future point of view. So thank you, sir. Thank you very much. Now, sir, we have Ravinder, sir. Ravinder, sir, is the Vice President of SBI Global Factor. So I think we had discussed that this factoring is also very important in case of export funding. So he will speak about the factoring from the factoring point of view. So, sir, thank you very much for joining with us, and I would like to invite you for your deliberation. So, Ravindra, sir, over to you.
Yeah, good evening, everybody.
Yeah, good evening, sir.
Yeah, if Mr. Rohan can play this PPT that I have shared. Yeah, thank you, Rohan. So, as our eminent speakers before me, they have already shared a lot many information about the international trade, finance, and the MSMEs in India. Those are facing lot many hurdles in arranging for the finance, and then coping up with the fierce competition in the international market. Factoring, we say, is one of the ways among others which comes to the rescue and to help of the MSMEs. For us, we are SBI Global Factor Limited. We are a subsidiary of State Bank of India, having 84% stake in this company. And our main activity is factoring. Rohan, please go ahead. Yeah, our main activity is factoring, and this is just a brief introduction that this company was established in '91 and merged with Global Trade Finance in 2001. Please go ahead. In short, if we say factoring, what is factoring? Then factoring is a receivable management service where you get instant cash against your credit sales. When I say this, we mean factoring is basically sale of your receivable to a factoring company for some discount, and then getting rid of all further hurdles of collection of the receivables from your buyer. When you enter into a trade, when the seller or MSME enters into a trade with the buyer, then they have certain terms, say 60 days, 90 days, 120 days, 100 days, whatever. And the buyer may choose to pay a little bit later, maybe with some delay of say 20 days, 30 days, 40 days. So factoring companies do understand this situation where the seller will not get his payments on the due date, but with some delay. And the factoring companies are ready, mostly factoring companies are ready to finance the trade up to that time when they are actually getting the payment. So your delay, when the seller is going to bank, or they are the borrowers of the bank, and they are getting CC, and they have got some credit period or cover period, and on the cover period getting overdue, the bankers are used to reduce the cover period and reducing the cover and reducing the DP and account going irregular. Against that, the factoring companies, they understand the actual receivable period, and they give the finance up to that time. So seller raises the invoices, he submits the invoices to the factor and gets the prepayment up to 90%, 85%, 80% according to their categories. And on due date, the debtor pays to the factor, and factor deducts its charges and remits the margin money to the seller. In case there is a delay by the buyer to make the payment, then factoring company will make the follow-up on behalf of the seller. It will make the follow with the buyer for collection of the money. Rohan, next please. Now, I just want to dwell upon here. There are two types of factorings. One is with recourse factoring, another is non-recourse factoring, which has not been which has not come out in the PPT. With recourse factoring is always when If there is no payment from the buyer, then factoring company will go back to the seller and say, this money is due from the seller. Non-recourse factoring is what we are seeing here, where the factoring company will say that seller has sold the invoices to me. Now it is for the factoring company to go to the buyer and recover its money in case of non-payment or with delay. In India, most of the factoring is done with recourse only, and non-recourse factoring is very, you can count it on the fingers. Most of the companies, most of the customers, they don't prefer non-recourse factoring for certain reasons. We may discuss them later on. Yeah. Go on next, please. Now we can have a short distinction between factoring and bill discounting, where funding is given on a better terms, disbursement is instant, the TAT is good, credit period offered is 180 days and around, wherein in most of the banking sites, the credit periods are restricted to 90 days, or nowadays, depending upon the working capital cycle, the credit periods are improved in the banks also. But still, the factoring company, most of the factoring companies, they still have a cutting edge on credit periods. In most of the bill discounting time, there are no grace periods allowed, whereas in factoring companies, grace periods are given. And discounting charges are taken in the bill discounting, it is on upfront, but in factoring, it is on monthly basis, on day to day. Whatever time you use the money, then it will be taken. And collection is very meticulously, since it is invoice to invoice financing, factoring companies do follow up with the buyer for collection of the receivables. Whereas in most of the bill discountings, this particular facility is not seen in most of the cases. Very few cases we can see that the following also done. Follow-up is also done by the financer, but factoring certainly they do. We can have some USPs and advantages. You can have instant cash. This improves the liquidity of the seller, and it reduces the operating cycle because you don't have to lock in your capital in receivables. You can basically have the promoters promote the business on open account. You need not insist for an LC, which is again a cost to the buyer, and most of the buyers are not interested or they're reluctant to give the LC. So you can promote the business on open account. Each invoice will be followed by the banker. MIS reports will be given. Credit periods are given at liberal time, and collection and follow-up will be done. The most important thing is the factoring are mostly done without any collateral securities. And second thing, the onus or the major criteria of funding is the strength of the buyer and not the financial strength of the seller. In our today's seminar, we are considering the sellers are our MSMEs, those who are more or less unorganized, not having access to big capital, not having access to big technology or information, I would say financial information or financial knowledge or intelligence. So their you say current ratio is weird, tail ratio is weird, and their holding levels, receivables, inventory levels are not that good. They don't have much collateral, and they are not able to access to the regular banking channels in most of the cases. I would say in all cases. But if you go say mudra loan or this type of loans where the government is sponsoring them, other than if these companies go for this banking channels, at times they feel that they are not getting that facilities as they are required. So in such cases, factoring comes very easy tool for them to get their funding, where it is collateral free and it is liberal. So this is a snapshot where we can go. It has to be a situation of open account sales where LC is not involved. It's a continuous relationship, and whole turnover of between this seller and the particular buyer is assigned to the factoring company. That means all invoices generated by the seller on that particular buyer till this arrangement is there, all invoices, whether factored or not, sent or collection, they will be routed through this factoring company. This is just to ensure that all the money of even factored or non-factored money invoices, they will come to the factoring company and it will be routed to the seller after deduction of the factoring company charges. Go next page. Here are few facilities that SBI Global Factor is offering. Let us start from top: export factoring, then domestic factoring, reverse factoring, then LC discounting, channel financing, vendor financing. These two are not much in vogue. One which is not mentioned here is trades financing, where we do participate as a financer on all three trades: M1, A trade, and RXL, where big buyers are as a buyer there, and all their suppliers as MSMEs. They supply their goods, they raise the invoices. Either the sellers or the buyers, they display their invoices, and we fund the invoices. Few products we can go. Row next is the domestic factoring, where the sales on domestic sale is financed, where financing the seller by prepaying up to 90% value of the bill, and we do the collection of receivable and maintenance of accounts related to account receivables. This is for domestic one. This is our flagship product and mostly accepted. Again, this product is without any collateral security. We finance 90%, and normally we go up to 180 days or slightly beyond that receivables. Next. We come to export receivable, which is today's key agenda. International factoring we do, as Tabrez sir already has discussed about international trade, and even I belong to State Bank of India, and I was also doing, before coming to this company on deputation, I was doing the same business. International factoring in SBI Global Factor is done on FCI's two-factor model. Many of the participants may be aware of FCI, that is Factor Chain International, which is stationed at Netherlands, and it has there around 400 correspondents all over the globe in around 90 countries. These participants do offer import factors cover to each other, and whenever suppose we have got one exporter or MSME exporter in India, and he is exporting to say China, or let us say France, then I approach my counterpart in France and say, my exporter is selling to one of the buyers in your country, and he is asking me a loan of say $1 million or $2 million, and please convey me whether that buyer is good enough for this particular amount. My import factor in that country, he assesses through his database or through his discrete inquiries how good that buyer is, and he conveys me, okay, you are asking me 2 million, but no, he is not good for 2 million, but okay, for 1 million he is good, and he offers me a cover of 1 million by obtaining insurance cover, back-to-back insurance cover in his country. So in such case, I go to my seller and say, okay, you had asked me a line, international line of $2 million, but your buyer is only good for 1 million. So I will offer you a line of $1 million, and you can discount your bills, international bills or export bills up to $1 million. And I discount his bills. I send the bills directly to the buyer. I intimate to my import factor, who is my representative in the buyer's country. On the due date, my buyer has to make the payment to the import factor situated in his country, and import factor will remit the money to me. In case my buyer doesn't make the payment, my import factor in the country, my representative, he is authorized to contact the buyer and ask for the money. In case within 90 days, if the money doesn't come from the due date, my import factor will make good the money to me, which I will pass on to the seller. But this money is interest. Interest meaning, in case my import factor decides to sue the buyer for the money that he has made good to me, then my seller has to make available all the documents and all the transactions to the import factor so that he can go and install a suit in that country. Again, since I'm already getting import factors cover, we are not going for any ECGC cover. ECGC insurance is not there, so that cost is saved. Then funding will be done in either in INR or in the USD or GBP or Euro or JPY. We do the funding in these countries, in these currencies, and LCs are not required. Of course, because this is open account, LCs are not required. Rohan, next please. Then this is reverse factoring. As we see in bank, we go for CC, hypothecation, stock hypothecation CC. Reverse factoring is nothing but CC on stock hypothecation. Again, this is normally a credit period up to 120 days, and this facility is available against bank guarantee, collateral security of the bank guarantee. This is not a regular product, but this is available on special demand of normally those who are having domestic factoring facility with us. Next please. Then this is vendor financing. Vendor finance facility is there, which is offered by big clients to their vendors. It is nothing but a dealer domestic financing, but here the big client, blue chip company, they have got lot many vendors like Maruti, Reliance, L&T. They have got big vendors. So they come to us and say, these are my vendors and they are good for, they are regularly supplying the goods to us. So why don't you make finances available to them against my guarantee that, okay, on the due date, I'm going to make the payments. So that way we are making the vendor finance. Rohan, next please. Then dealer and channel financing, as we all our banks, they do have EDFS facilities. This is a similar product to them, where we the big manufacturers, they come to us and say that we have got lot many dealers across the country and they are regularly procuring the goods from us for their merchandise. Can you finance to them wherever goods will be supplied by us, and in case of non-payment by them, we'll follow your instructions of stopping the supplies and all. Rohan, next please. So this is simple process how we can finance. Then we get the application, then offer letter is sent to the client, and then we do the sales ledger analysis and field survey of the transactions between seller and the buyer. Whether there is a purchase order of say 90 days, but actual payment is coming in 120 days. So we fix the limit for 120 days and not 90 days. In addition to that, we offer some grace period of say 15 days or 30 days, depending upon the seller's request. Then we balance sheet analysis is done, proposal is submitted to the sanction, it's sanctioned, documentation is done, and we sanction the limits. So, these are most of the charges, normal charges. Of course, SBI Global Factor is an NBFC, non-deposit taking NBFC, so we can't beat the bankers' rates having CASA funds. Our rates are a bit higher, but okay, then we can justify the rates with our TAT and fast services. So that's all from my side. Thank you, sir.
Thank you, sir. Thank you very much, Ravindra sir. You have given very good insights about all the products, and there is, I think, great learning also that without LC, even the exporters can get money with that input factor and the input factor and all. I think this is one very good thing which I think you have highlighted. So thank you very much once again to deliberate your products and all these things. Thank you. Friends, now we have Randeep Mukherjee ji. Randeep Mukherjee ji, the regional head structured trade sales in ICICI Bank, and he the person actually who was involved in the integral member of the consortium formed across banks to set up the country's first blockchain-based domestic trade finance solution. So he is the right person to speak about the technology-related changes in the export financing. And other than that, he can also guide us about the factoring from the bank's point of view. We have listened from the NBFC point of view. Now he can basically give us the complete idea from the bank point of view. So thank you very much, Randeep ji, for joining with us. And I would like to invite for your deliberation. Over to you, sir. Thank you.
Yeah. Thank you, sir. Thank you, Mr. Ashish. And thank you to all the speakers so far. It has been a very insightful discussion so far, and a lot of the products have been shared. So I will not, I don't have a presentation, so I will not give you the products. All the products have been covered. I'll just give you some of the insights from the banking perspective. So firstly, I wish all of you are safe and healthy. It has been tough 1 year, and I hope we all come out of this sooner rather than later. And I hope all are vaccinated. So in this pandemic that I've seen a lot of large corporates going in, focusing on supply chain, not only on the supply chain, the financing bit, also on the physical supply chain. So while we understand, and you all are the experts as the MSMEs, you are the bedrock of the economy finally, and you all are also doing a lot of good supplies and effectively holding up the economy. You all should not feel that supply chain is only the way you all are getting constrained. And I can assure you, can tell you, all the large corporates are also feeling the same pinch, and they would want to, they are very happy to go into supply chain financing because they don't want their whole physical supply chain to be affected. So even the MSME suppliers to large corporates, the large corporates do not want the MSME suppliers to be impacted, and hence they want financing at easy rates there also. And that's where the factoring, as Mr. Ravindra mentioned, and also Mr. Tabrez mentioned earlier, why the factoring and all these products are coming into it, because it is a way of giving easy supply chain finance to the entire chain, not just the large corporates. So you all are as MSME suppliers and as businesses in on your own books, you all will note banks generally have a historical way of assessing working capital, assessing the balance sheet, and at times that are the traditional modes of doing credit assessment. But we have seen of late, what we have observed and what I have also seen is we are looking at a lot of it in cash flow, seeing how the cash flow is moving, how your working capital is moving fast, and you're doing cash flow financing. In effect, like when you are supplying to a large corporate and you are seeing regular supplies coming, regular money coming into it. So we are happy as a bank, and the banking sector rather, we are happy to get into a factoring agreement with yourself by doing 100% discounting without recourse, by blocking limits on the bank, on the anchor corporate, which is a large corporate whom you are selling to. So MSME is selling to large corporates, happy to enter into transactions with the MSMEs, so much so that the entire goes without recourse to you. So it's a true sale on your books. It is like an early liquidation, and the risk is taken entirely on the anchor corporate. So that is one thing that we have seen a lot happening. Since 2015, RBI has come out with guidelines allowing banks to also do factoring, and hence this has been picked up in a large way. As Mr. Narayanan said earlier, that globally factoring is here to stay. It is just now that it's picking up a lot in India. So that is number one. Number two is what Mr. Ravindra mentioned on this FCI platform, Factors Chain International. It is a very bustling, good network of foreign banks and Indian banks, also in Indian factoring companies as well, who are here, and you can easily go across, try and get a deal for an export deal. As in, you can try and offload your risk from that overseas counterparty by doing a transaction with one of the factoring companies or with one of the banks through the FCI platform. So that is another second one which has picking up a lot. It's honestly, domestic is higher than the export factoring, but I think that the focus on export factoring as much as there among the factoring companies, and the NBFCs have now been allowed by the Factoring Act to do this as well, and also by the whole trades platform that you all must be aware of for the domestic. So these are some of the things I think you all should do. You all should do exports. It was told by one of the earlier, Mr. Tabrez said, please go outside, please do an export, and please don't think that this is something that only large companies can do, or large. Let me assure you, when I as a banker am speaking to a lot of clients, it is the same challenge everywhere. Same challenges, same issues, and same products. So you are not different from a AA, AAA, or any large Sensex company. It is the same problems. It may be different, but if you are selling to a large corporate, we are happy to take the risk of the large corporate. But one important point I think all of us have mentioned, I'll just reiterating, when you're going overseas, when you're doing, keep a risk management policy in place, because please understand, please remember, you're in the business for selling your underlying product, and you're not in the business to make money of the Forex gains or Forex losses. Everyone thinks the market will go up, the 73 may become 75, a $75 rupee may become 76, and I will earn more money. Please don't keep that in mind. Focus on your base product and hedge your FX exposure so much so that your risk is covered. So keep that risk in place. It's like a normal equity. I don't need to advise you all. You all are masters. You all are running great businesses. But just keep that risk. But sometimes that gets very, as if I may say, attractive. Dollar is going up. I will sell. I will get more rupees back. Please don't keep that mindset, because we have seen the other side as well. If rupee appreciates and dollar crashes. So let's not play with the market. Focus on your underlying business. Keep a risk management policy in place. Undertake factoring. Reverse factoring is for the payment side. Mr. Ravana covered it. But go in for the export packing credit in rupee. That was also shared by the first two speakers, where you get subvention, interest subvention, and some places for some sectors, MSMEs get up to 5%. So there is a potential of getting rupee packing credit at near zero cost. I will not go into that. It was already shared. I will not repeat. So keep a risk management policy in place and ensure you keep doing what you're doing well. The banks will banks and factoring companies, all the financial sector will take care. We will give competitive pricing, and we'll ensure that you are able to rise along with all the other corporates in the country. Because if you all are not doing well, financial sector will not do well. So all the best. I will hand it over back to Mr. Ashish. Thank you so much.
Thank you, sir. Thank you very much, Sandeep ji. I think you have very good, given the very good advice, and the confidence which you have given, whether you are AA or AAA, or you are basically in the MSME space, the challenges are same actually. It might be basically the larger companies are having different challenges, and the small companies are facing different challenges. But the challenges are there actually. So they should not restrict themselves for export without keeping in mind the challenges are there. So that's a very good advice, and I think audience or the participant will follow the same. Thank you very much. Now I have Mr. Dhruv Bajaj. Dhruv Bajaj is the person who had worked in various organizations, and he running a fintech company called Enkash. So I think in the current scenario, the fintechs are also doing a lot of disruption in the entire industry or entire global trade finance. So I would like to invite Dhruvji to give his deliberation and just give us the idea that how the fintechs are helping in the global trade finance, and what are the areas which they are covering, and in terms of the turnaround time and all these things, how they are managing these areas. So over to you, Dhruvji, and for your deliberation. Thank you.
Thanks a lot, Ashish, for inviting me for this webinar. So I will not talk on behalf of Enkash, but I'll talk on behalf of the fintech community as a whole, how fintech community is kind of helping global trade finance opportunities all over India. So basically, if we talk about fintechs, they are playing two kind of roles. One is they are playing at the back end, wherein they are enabling a lot of banks and factoring companies to provide funding in a much faster manner and in a much more. Hello.
Please carry on. Please carry on.
One is that they are kind of helping a lot of banks to provide funding in a much faster and in a much more seamless manner. For example, we have a very popular company called Ripple, which will enable transfer of remittance within bank without having some intermediary banks in between. And I think in India, SBI has already adopted Ripple, and HDFC has also adopted Ripple. Ripple is something called, is using a backend technology of blockchain cryptocurrency called XRP. And they are basically enabling transfer of funds from one country to another country in a much more faster manner than SWIFT. So that is one way where fintechs are enabling banks to do faster financing. Second is, yes, blockchain is helping to develop a lot of decentralized but distributed trust platforms within the bank. And the biggest name in this segment is Coda, which is kind of Indian bank blockchain infra company, is also adopting this enterprise blockchain platform, in which I think 15 Indian banks are already part of IBBIC, including ICICI Bank and SBI. So what they are developing is a trust-based platform wherein they can do invoice finance as well as LC-based finance in a much more seamless and faster manner. So how will it help MSMEs? It will help MSMEs to get finance much faster. The export bills will get accepted much faster. The acceptance of the since LCs will be issued on a blockchain framework, जो physically कई बार you go and check the LCs, that overall transition time, everything will reduce very substantially. So that is where fintechs are helping MSMEs by acting on the back seat, and in the front seat there are banks which are helping banks to do transactions in a much faster manner. A second trend which is we are now seeing in a lot of fintechs is that a lot of fintechs are actually coming on the front seat and actually trying to talk directly to customers, and they are trying to do it in primarily three ways in India. One are typically factoring fintechs, and which work very similar to how SBI factors work or any other factoring works. They take a credit insurance of the buyer and get funding through some international fund houses, and do financing for SMEs. The cost of funds are little higher than banks, but you get timely financing because a lot of the process is 90% of the process flow is digital, except the documentation part of it, which because of Indian laws, a lot of documentation is still manual. But besides that, the credit analysis, the limit sanction, the disbursement. So the entire journey, 90% of the journey has become digital. So there are international fund companies like Drip, Stern, Modify, which are doing it. And there are Indian fintechs like Revoy and other which are coming up in this segment, and they are providing factoring services. Basically, they come up with solutions like accounts receivable factoring, which is nothing but accounts receivable finance, which is nothing but factoring. And they're also very soon coming up with a product called future accounts receivable finance. So future account receivable finance is basically PO based financing, and it can be something on a banking parlance counterpart to something called as a pre-shipment credit, wherein you get a credit from the bank against a confirmed LC or a purchase order. So that is one part wherein kind of fintechs are acting as a factoring fintech. A second way of looking where fintechs are making some ways, and right now they are taking some nascent stage, are fintechs are acting as a supply chain finance fintech, and companies like Prime Revenue, Demica, Tolia, these are all actually acting. They do tie up with the key player. For example, if you are an exporter to Nike, or if you are an exporter to Gap or these international brands. So what these fintechs do, they do a first level tie-up with these large purchase houses. And then they also on the other side do tie-ups with a lot of multinational banks like Citibank or Standard Chartered. And then they approach their Indian counterparts and they fund their Indian exporters who are actually supplying to these large corporate houses. So this is nothing but an international level supply chain finance which is happening. So I think in India, I think Standard Chartered is a bank which is kind of doing it very aggressively, and not very sure about other banks whether they're doing. But yes, if you are supplier to a large corporate, then this is a good solution for you. Third way where fintechs are acting is like they are creating platform for early payment discounting. This is called as a dynamic discounting fintechs. Companies like C2FO, Credits, and Prime Revenue are quite popular internationally, and now they have put up their footstep in India also. Here, basically what you are saying is that if you have 50 suppliers to one large corporate, and if you want some early payment, you can ask for a cash discount. But it's not practically possible to negotiate cash discount for every vendor by that particular buyer. So all 50 vendors are put up on a particular dynamic discounting platform wherein you negotiate your cash discount rates. So the person who gives the best cash discount is the person who is able to get his bills or invoices discounted faster. So there you are getting a finance from the buyer itself. You need not approach a bank there. So these are primarily 2-3 ways wherein fintechs are putting up their footstep in terms of export financing is concerned. There are a lot of experimentation which is right now going on. One is obviously on e-commerce platform. Some fintechs are coming up and providing the embed finance on Alibaba. And if I talk about Alibaba, there. And if I talk about Mocklix. So these are all platforms wherein some fintechs are acting and providing international finance solutions. Then there is concept of whether can P2P lending or crowdsourcing can be other solutions. Can export LC aggregation can be a solution. So these are all experiments which are right now going on at the back end, and the solution will subsequently come in India. So I'll kind of conclude in that way that if you are looking for least, if you are an exporter, if you are looking for least cost finance, then at present, obviously banks are the best solutions. But if you are kind of okay to pay a little percentage higher and get a timely finance, then there are other solutions available in the market.
Thank you, Dhruvji. I think you have given very good perspective because a lot of disruption is happening, which is I think very good to know, because we should keep eye on the new developments. Otherwise, we will be I think lagging behind. So that's a great idea which you have given. Different fintechs are doing different things. So I would like to advise all the MSME players that should keep eye on that. Actually, they should keep reading of the development, and it might help them to get the better the funding at the better rates, or maybe the right kind of funding also at the right time also. So I think we had a good discussion with all the panelists, and everybody has contributed a lot. We could know many things, that various schemes, various initiatives, various incentives, and how we can get the funding, what are the information required, and everything we have, I think, discussed today in today's webinar. And our participant is also asked many questions. I'll try to, some of the questions have been replied by our panelists directly to the participant, but still some questions are there which are unaddressed. I will take one or two questions because of time. So the one question which is, I think, which has been asked by Mr. Anil Kumar Tanwarji regarding this, what is the interest rate range for factoring? Because everybody is concerned with this interest rate in case of export funding. So if I think we have Ravindra ji or Randeep ji, you can give some idea that what kind of interest rates range are there for the factory. That'll be good.
Sir, for export factoring, normally we charge 3 months Libor plus 200 to 300 BPS. Of course, it is negotiable based on whatever terms we get from our input factor and our cost of funds. But normally it will range between L plus 200 to 300 BPS.
Okay, good, sir. I hope that Amit ji must have got the answer of this query. Then we have one question for Tabrez ji. So Vijay Kumar Sinha ji has asked, what are the documents required for export packing credit? So you can give some idea about the documents required for export packing credit, sir.
Yeah,
Tabrez,
yes, sir. Yes, sir. See, as already I've said, first to be eligible as an exporter, they should be registered for EXIM. That is, there is a code that is given, that is required, very important. And the other, I think, PAN number and everything will be available. For the export packing credit, he should have a confirmed order from the abroad. That is very important. Order can be against the LC or without LC also. And for the EPC, I'll tell you that how does the bank assess? Bank asks what will be the turnover in a year, next year, what will be the turnover from the exports. So roughly something around 20% of the turnover is as per NIC committee, and that is also applicable for gold card. 20% of the turnover of the export that is coming from the exports can be funded as EPC, packing credit. So document other than all those documents, that is PAN number and all those things, that is basic formalities, confirmed order is important. If you have a confirmed order and you are going to be a regular exporter, that is sufficient.
Thank you, sir. Thank you, Tabrez, sir. I think giving the idea about the documents required. And one question is has been asked, which is I think repeatedly asked by some of the participants. They are basically this question. Sir Abhishek Kumar has asked from Ramesh sir. There is a gap between the exporter of India and bank. Banks have fear of giving loans to new exporters like me with good credit score. How this gap can be fulfilled? So Ramesh sir, can you reply on that question?
Basically, let me be very clear. Going by the score of the credit, export packing credit is not decided, export financing is not decided. Export, that is for this reason that you can see that rating A1, then rate of interest will be this, or if A2, rate of interest will be this, which is in credit financing is done. In export packing credit, export is exporter. So banks will always say, okay, whatever is working capital cycle is there, to that extent, rate of interest is fixed. Up to 180 days, if the bank decided that packing credit can be given at the rate of say MCLR plus 1%, it will be same. No, it is not like it is a D-rated customer, so it will be MCLR plus 4. No. So that is why the credit score is not that material as far as the export packing credit. What you need is a confirmed export order and also the insurance available for export credit, the country where exporting, all these risks are being taken to by the bank.
Sorry. So there is one question from Sankara Narayanan sir. This has been asked by Akhil Handaji. This is how UCO Bank is helping the new startup in export loans. Can a new firm registered with a year apply for the said topic? I think this has been already replied by
It
Ramesh
has
sir.
already been replied. They can actually contact. I have already provided our contacts to him directly.
Okay.
And
Okay.
they can contact us actually. We can take up the matter directly with them.
Okay. Then one more question is there, that how factoring is working for African countries, which maybe fall under higher risk category. So somebody can, if somebody can take it. This is a very important question. I think many times this question is coming in the discussion.
Yeah, so I'll try and answer that. So African countries also are, rather banks from African countries are also available on FCI platform. And as I said, FCI platform has around 400 odd members. So while having said that, US and Europe will have much more coverage given the inherent benefit in these geographies. But African countries also and companies in Africa also covered under FCI. So it can be done, it can be reviewed.
Okay. And one more question. I think this is the last question which I'll try to take. This is from Sandeep Khandelwali. Whether factoring and export financing be availed simultaneously for selected receivables respectively?
No,
It
it
was
cannot
how
be.
it is possible. It is not possible.
It's either one or the other. It cannot be both. Because
It
one thing
cannot
RBI very regulators clearly look at is double financing risks. So either it is discounted for via factoring or export credit is taken. It cannot be both.
Okay. So great. I think now we have closed this session. Actually, we already overshoot the time, but we had a good discussion. I believe that there will be some knowledge enhancement also, and some of the MSME players who were very keen to understand how this global trade finance is happening in the country for MSME, they will be benefited out of it also. So I would like to thank you to all the participants who have come from different part of the country or from the global also, for joining with us and making it more interactive. Then the panelists, actually, the people who have accepted our request, and all our industry experts. So you have given a lot of inputs which will be helpful to all of us. And thank you very much to all of you for joining with us and making it more interactive, more knowledgeable. And I hope so, because this is a very important topic, and I was discussing with the panelists that it cannot be covered in one discussion. There are many unaddressed areas are there, which is the export in this credit insurance, which is very important. This the transition of the Libor, which is another area which is, I think, impacting a lot. People have to understand in advance, because what will be the impact on the existing export financing or the trade financing, and what will be the future of the trade financing after this transition of Libor actually. So that is the area which we need to cover up. Then there are many other issues are there which need to be taken up. So as Resurgent India, we are committed to bring the industry or the experts together and understand the different issues. So we will try to cover these topics in the later seminars, and hopefully our audience or our participants get the advantage of it. So thank you very much. Thank you all. I would like to thank you.
Thank you so much, sir.
Thank you very much.
Thank you, sir.
Thank you all the panelists.
Thank you, everybody. Thank you.
Thank you, Ashish.
Nice of you.